Hi, everybody. In the interest of time, I think we'll make a start. Good morning, everyone, and welcome to the K3 Hub. For those who don't know me, my name is Marie Wadeson, and I'm a managing director here at K3. And I also lead the K3 Hub. The K3 Hub is an integral part of the K3 Advisory Group, which is backed by Sun European partners and employs 1,200 people. Our areas of specialism are business sales and deal advisory, wealth management, financial and restructuring advisory, technology advisory, and tax advisory services. So just moving on to a few housekeeping points for today's webinar just before we get underway. So as you will have seen as you joined the call, we are recording today's session. It'll be placed onto the K3 Hub website next week. We normally share the slides in the chat, but today we're not going to. But what we'll do is we'll send you the accompanying documents and presentation via email after today's session. Q&A function is open, so please do feel free to ask questions as we go along. I'm going to be chairing Q&A today, so if you could do me a favour and put all of your questions into Q&A rather than chat, it just helps me keep everything in one place and so that I don't miss anything. It's likely that we will have quite a lot of questions. I know that we've had quite a few come in already ahead of the session. If we're not able to get around to all of them, I will pass the relevant questions on to the speakers and they will come back to you after the session. Okay, so moving on to today's webinar then. So this is another two-part session. So up first, we've got a market and economic update during which our speakers will discuss the impact on the ongoing conflicts in the Middle East, which are having on both the economy and investments markets, what to do from an investment perspective during heightened geopolitical volatility, and the importance of long-term financial planning during uncertain times. We'll then move on to the second part of today's session, which is a session on share valuations, during which we'll discuss the different types of valuations, market value in the context of legislation and case law, valuation methods, and earnings valuations, net asset valuations, and minority discounts. So I'd like to move on to our first session and introduce our speakers today. So I'm delighted to welcome back Marcus Pilkington from Pareto Financial Planning and Alex Brandreth from Luna Investment Management. Both firms part of the K3 Advisory Group, and together they advise private clients and their professional advisors on personal investment strategies, pensions and wealth protection, and also provide bespoke portfolio management. Marcus is a chartered financial planner, and Alex is responsible for coordinating the overall investment strategy at Luna. Just before I hand you on, we have had one or two slight hiccups with Alex's video this morning. Please bear with us if that continues. But otherwise, whilst we still got him, over to you two.
Brilliant. Thanks, Marie. Morning, everyone. I'm not sure what's wrong with my camera this morning, but as I said to the other guys, you're not missing much if I drop off anyway. So, look, I think we did this call 3 months or so ago, and we were pretty optimistic then as we were looking through the year ahead. We had a backdrop of interest rates falling in the UK and globally. We had a backdrop of fiscal stimulus from governments. So we had the One Big Beautiful Bill Act, which Donald Trump's introduced, and Europe and particularly Germany are doing a massive infrastructure spending as well. So we were pretty optimistic, and then on comes the 28th of February and Donald Trump did his usual tricks. And it's really impacted and knocked investment markets. It's impacting economies. I think we've already started to feel it and notice it. So felt like that was a sensible place to start today. So if I go through kind of what's been happening, which is changing on a daily basis, and then Marcus can come in and talk about what to do in these environments. So I'm just going to share some slides. Two secs. Okay, so the first point to make is that the central view of most individuals is the most likely situation is a de-escalation of the conflict. I mean, you've already started to see this with the ceasefire being extended and agreed, but the problem is you need both parties to agree. It looks at the moment like the US are trying to do it on their side, but you need Iran to agree on the other side as well. And common sense at times like this, unfortunately, sometimes just goes out the window. You need both parties to come to the table and agree, and at the moment they seem far off from being able to do that. The negative is the longer this goes on, the bigger the impact it's going to have on the overall economy. So we've already seen the oil price, and I've got a slide on that pick up. And as inflation picks up, economic growth comes down, and that is a nightmare for central banks. That's exactly what you don't want. That's stagflation. So you've got inflation increasing and growth being weaker, and the central bank, that's against what they want to have and do. So what I mean by that is when you've got economic growth that's weak, you want to cut interest rates. But if you've got inflation, which is high, you want to increase interest rates. So they're kind of opposing forces at the moment. Markets, whether that be bonds, whether that be equities, moved a very long way in March. And as soon as a ceasefire was announced and it looked like there was going to be a de-escalation, you've seen an almighty rally back in stock markets and bond markets as well. So it's important when you see periods like this, volatility is in both directions. March was incredibly weak, but then April so far has been very strong. And this isn't the first time that we've seen this. If you only have to go back a year ago when Trump introduced his tariffs, that we saw exactly the same impact come through. The tariffs were introduced and the markets were very weak. You then started to see trade agreements being done and markets rallied back significantly. What do you do in this environment? And this is where Marcus and myself earn our money in periods like this, because the tendency is to panic, the tendency is to worry and therefore to sell. And in our view, that's always the wrong thing to do. And it's probably been highlighted already over the last 6 weeks. If you're really worried about it and you sold at the end of March, then you would have missed the rally that you saw in April. Again, last year, if you'd sold at the beginning of in the middle of all the tariff concerns, you would have missed a very strong return. I mean, the FTSE All Share delivered a return of over 25% last year. So it gives you an idea of staying invested through these times is the most important thing to do. And that's, one that was on a call yesterday with someone and they said, what do you do at times like this? And he said, I turn off the TV. I don't read the news. I don't keep up to date with what's going on with short-term developments, and I focus on long-term signals. I don't know, Marcus, it might be a good opportunity for yourself here just to maybe touch on the importance of long-term investing and what you speak to clients about in the short term.
Yeah, indeed. And I think that obviously what we've seen is we've had another period of volatility. And I think you rightly said, I think clients in a way have almost got used to that volatility. We had, lockdown not long ago. We had the Russia-Ukraine war, and then we had the tariffs, and then it's another event. And I think historically, if you look pre-lockdown, we would probably have a big financial event, maybe one every 5 or 6 years. Recently, we've had 4 in 6 years. So I think clients have actually become a bit more used to the fact that something's going to happen, unfortunately. And as you said, I think people are a bit more comfortable with it, maybe. I think if clients stay invested, and if we look at client portfolios, I've been going out seeing clients, and if you look over the past 12 months, the returns are still really, really positive. Many clients are still having double-digit returns, even for lower risk clients. So, yes, there's been a period of volatility. I think clients are a bit more becoming a bit more used to kind of sitting on the hands and not doing anything and not panicking, because as you say, markets fall. The instant reaction is, what shall I do? Shall I do something? Shall I put it in cash? But as you correctly said, markets will rally quite quick on a bit of news, and Trump can, as we all know, change his mind from day to day to day to day. So it's quite difficult to pinpoint exactly what's going on. So obviously looking at it over, the past 12 months as a minimum, rather than the past 4 weeks, and look at it over the longer term, despite markets being very up and down over the past 4 or 5 years, a lot of clients, mid-level risk portfolios, have still done, 40% plus. So they're still averaging 8% a year. And that's just by, holding fire and not doing anything, not panicking.
Yeah, absolutely. And just to give some information on what we do at Luna, um, as soon as the event happened, we sat down on the Monday morning after the it started at the weekend. We talk about what do we want to do. We assess it. We think about where the areas that are going to be most impacted are going to be come through, and try and make decisions quickly. Because I mentioned don't panic, but if you are going to panic, try and do it as early as possible. We did make some changes basically the Monday after the conflict started. What's been happening? I think everyone knows this, but the Straits of Hormuz is effectively closed, and that's crucial because it's 20% of global oil, it's 20% of liquefied natural gas. You see there, it's around 50% of fertilizers actually go through the Straits of Hormuz as well. So it's having a huge impact in terms of all commodity prices. And this is oil. So we've purposely taken this back to 2021 because it shows when Russia invaded the Ukraine. You can see the spike up there on the oil price. It increased significantly to over $125. We then, as things calmed down, and I mean, that war's still going on, you can see that the oil price declined as we went into early 2026. And then the far right-hand side of this chart, you can see what happened to the oil price. So it was picking up already this year. So it picked up to around $75. But as the war started, it spiked to $110. More recently, it has been coming off its highs, just under $100 as we stand here today. But you can highlights that we have been here before. We've seen oil price spikes only a few years ago. It's normal, unfortunately, and it's not just the oil price that is spiked. You've seen other commodity prices spike as well. I mentioned natural gas and fertilizer. And I think the important thing to mention is when things get back to normal, because they will eventually, it's not going to go back to where we were. I think that's an expectation that people have that, this will just get sorted and we'll just get back to lower commodity prices. That's not going to happen, and it's unfortunate, and that's not going to happen because the damage that's been done in the Qatari liquefied natural gas station, which is managed with Shell, that's going to take 3 to 5 years to fix. That's one of the biggest exporters of natural gas in the world. So we are going to have to be getting used to a world of slightly higher commodity prices until this infrastructure is fixed. I think the other important point to make, though, is that don't underestimate the ability for countries, companies, and individuals to adapt. Europe basically had to create a completely new energy source during when Russia invaded the Ukraine because they were so reliant on Russian natural gas. And they were able to do that within a very short period of time. You've already seen pipelines opened that avoid the Straits of Hormuz by the Saudi Arabia, and you'll see more and more options like that coming on stream as well, which should reduce the amount of reliance on that. It's going to take time, but things will start slowly get back to normal. And what's the impact of this been? So this is inflation. Again, purposely taken back to January 2022. And one of the things that's, we always say, be wary of anyone that says it's different this time. But it's slightly different this time in that when Russia invaded the Ukraine, we were just coming out of COVID. And you can see that at the beginning of this chart, inflation in the UK was running around 5.5%. It spiked to 11%. The bars represent the different components of inflation. So you've got services, core goods, food and alcohol. Then these two big bars at the top here, which is electricity and gas and fuels. And you can see the impact that had when we had higher natural gas and fuel prices 4 years ago. What's happened since then? Inflation's gradually been falling. As we touched on at the beginning of the year, the Bank of England were expecting inflation to be 2% in the next couple of months, which is bang in line with their target. We actually had a inflation reading this week, and inflation has picked up to 3.3%. And you're already starting to see that this is being felt by UK consumers. So one of the biggest increases that we saw this week was petrol, and so the liquid fuels element coming through, and that touches everything. That touches us when we're going to fill up our cars in the petrol station, But if you're transporting any goods around the UK, then it's going to have an impact. The other noticeable impact has been on airlines. The airline industry is running low on fuel, and Lufthansa this week announced that they're cancelling a number of flights in the summer just because they don't have enough fuel to be able to fly the planes. So this is certainly having an impact. And as I mentioned right at the outset, the longer this goes on, then the bigger that impact is, the longer the energy prices will stay higher and the bigger the inflationary impact. And not to worry people, but we are, as I said, going into planting season at the moment, and fertilizers are a key input into that. So if fertilizer is more expensive, and it's going to be more expensive for food prices as we move through the course of this year. So it's a potential for another wave of inflation to come through. And then I suppose this is relevant for everyone on the call. What we saw in 2022 and 2023 is the second order effects of inflation. If you're seeing inflation and your goods increasing on an annual basis by 10%, the first thing that we're all going to do is go and knock on our boss's door and say, excuse me, my cost of living's increasing significantly. I need a pay rise. And it will be the public sector that does that, and it'll be the private sector does that. And that gives another inflationary impact that can come through. I don't know how long this is going to last. I don't have a crystal ball, but the longer that it happens, then the bigger the risks are that you see other inflationary impacts come through. Now, I'm a bit sad, and I apologise for that, but this is my favourite chart at the moment, and I'll take a second just to explain it for you. So this is what the interest rate for December of this year expectations were. It goes back to the beginning of last year. So in January last year, what was the expectation for interest rates in December 2026? I've highlighted where we are today, which is that big red box around 3.75. So interest rates in the UK at 3.75%. And as we move through last year, you can see the expectation was that interest rates would be cut. So at the beginning of the year, the expectation was interest rates will be in December 3.25%. So we would see 2 interest rate cuts this year. And that was really positive. That's positive for people on mortgages because it means you can get cheaper financing. It's good for companies if they issue debt. It means they can do that on a cheaper basis. It's stimulative for the economy. If you're now getting a slightly lower return on cash, then you're more likely to go out and spend it. So it's positive for the economy. But you can see there, well, what the expectations have been since the war started, and they've skyrocketed. So we've gone from an expectation that interest rates will be cut twice to, at the worst possible point, that interest rates will be increased almost 4 times. So quite the shift in expectations for interest rates. That has moderated, and you can see there that interest rate expectations have come down. So it's now expected that we'll see probably 1 interest rate hike this year. So it's completely pivoted in terms of the market backdrop. And that's already fed through. So I was very fortunate. I sorted a mortgage change in January at these lower rates, but you're already seeing mortgage rates being pulled. You're seeing mortgages going on higher rates, and that's just going to take more and more people's income away that they can go away and spend it. Marcus, I don't know if you've got many clients that have got money in cash that's been highlighted this to you at all and mentioned it to you.
Yeah, it's a good point, actually. I was going to say, because we've got some clients who are maybe have funds to invest, and obviously they're quite nervous about putting the money in. So some are confident doing it over a longer term basis. So rather than, I've got a client who sold a business, potentially investing a couple of £1 million. And obviously for him, rather than, investing it all on day one, we talked about drip feeding it in over a 12, 18-month period, which he was a lot more comfortable with. But you will get clients at the moment where, you can get over 4% potentially on a deposit account. And if the expectation of rates is going up, people are a bit more comfortable maybe sitting on the hands. They're getting a slightly higher return on cash. But obviously the offset against that is, if inflation does go up, that obviously eats into that return as well. And obviously, if it's not in the market, yes, we can get some volatility. But as we always know, markets will pick up relatively quickly. And if you look back a couple of years ago, a lot of clients were sat on cash because they could get 5.5%, 6%, as we know. But actually, when you look over the past 2 or 3 years, if they'd have just sat and held that money, they would have got a considerably higher return from investing it even on a lower risk basis. So it's quite I think it'll be interesting, like you say, to see what happens over the next days, weeks, months in terms of the impact on markets and views. But we do have a lot more clients who are a bit reticent to invest in the belief that the money's secure and they can potentially still get a fairly decent return on cash.
Yeah, no, absolutely. And this kind of highlights the quandary that the Bank of England have as well, really, in terms of they want to be cutting interest rates because there was information out from the World Bank this week that showed that the UK economy is the most impacted global economy from this event because we're so reliant on importing commodities from external sources and we don't generate ourselves. Ironically, the US economy is the most insulated from this war because they produce a lot of the commodities and themselves, and they're naturally looking to benefit from it and be a net exporter of commodities and oil, etc., on the back of this as well. So UK economic growth has been revised down quite significantly, and I think this is an important point. And whenever you see concerns come through, people automatically say, "Oh, are we going into recession?" We don't think that's the case, and that's what most of the central banks and statistics bodies are saying. They're kind of expecting UK growth was meant to be around 1.5% this year. It's more likely going to be around 1%. So still expansionary, but just not as strong as what it was. And it's not just the UK that they've seen growth revised down. It is Europe and it is globally as well. China won't want this to go on for too much longer because Iran is biggest exporter to China in terms of oil. So China won't want this to carry on for too long because it's going to be impacting how much the cost of oil is to them. And then on the flip side, as we mentioned, we saw interest rates increase significantly in 2022 because of the fact that inflation was so high. But the starting point nowadays is different. In 2022, interest rates were zero and they went to 5.25. Today, we're already at 3.75. So it's unlikely you'll see the same impact on markets that you saw in 2022. Just wanted to show you a few highlights. I mean, this is what equity markets did in the first quarter. As I said, these charts are all out of date now because markets have bounced back significantly in April. But I mean, it's important to remember that January and February were very strong months. The FTSE All Share was up nearly 10% at the beginning of the year. You've got Japan, which is that orange line there, that was up nearly 20%, about 17% up until February. It's been the US which has suffered a little bit more. The NASDAQ, which is the technology orientated index, was down around 4% at the beginning of the year. And just to bring that back to the bond market as well, you've got government bonds, which is that blue line at the bottom with corporate bonds in that maroon colour. You can see how strongly things were in January, February, but how quickly that disappeared in March as markets came off. As I said, these charts are out of date as well because they have bounced back significantly in April. But I think this is something I'm going to touch on, and Marcus as well, is, look, we've been here before. This is previous oil crises that we've gone through, going back to the 1970s. And the blue bar is the S&P 500 cumulative returns over that time period. You've got the Iran-Iraq war, you've got the Gulf War, you've got the pandemic. It's obviously not an oil crisis, but it did have a massive impact on markets. You've got Russia's invasion of Ukraine. And just highlighting the point that it's never nice and pleasant to go through these periods. But what you've seen over time is that markets tend to go on and deliver strong returns over the long term. So the long-term return from investing in equity markets is around 8% per annum. It's actually 10% in the US. And you can see that that's despite all of these events that come through and happen on a regular basis. Don't know if you want to touch on anything here, Marcus, at all.
Yeah, I think it's quite a lot of the work we do when we talk to clients. We meet with them on a regular basis. It's we always sit down, even if it's the first time you sit down with a client and you talk about the long term view, and everyone nods, everyone goes, "Yeah, I understand that." And you talk about risk, and you say, things will go up and down. We focus a lot on capacity for loss, which is how much something could go down. Clients tend to focus on how much can I make, but part of our job is to make them understand how much it could go down. Like during lockdown, for some clients, it was a bare minimum of 12-15% higher risk. It was, 30% plus. So it's just to, get that understanding over that, markets will go up and down. But I think the thing to focus on, like you said there, Alex, is it has been a volatile period. I think people have got used to, Trump doing what he does, a world event happening, markets being impacted. But if you do look back over 5 years in particular, exclude going back 10, but if you look back over five, a lot of the funds that we've got with you, for example, Alex, have still done, the really, really positive returns. 12 months is still really positive. So it's having discussions with clients, those clients that are maybe drawing income from the portfolios. The portfolios are still up a lot. So for some clients, we've taken some profit. We've put that into cash to meet income needs for for the next 12, 18 months. So that gives them a bit of peace of mind. But it is just, getting in touch with the clients, speaking to them, letting them know how things are going. But I think I think if this was the first event that we'd had in 4 or 5 years, I think clients would be really nervous. But actually, because of the consistent nature of something going on every 12, 18 months, clients have actually got a bit more used to it, even those clients that have been a bit nervy. So it's just about, talking about that longer term view. We do a lot of cash flow forecasting for clients as well, looking at the longevity of the funds. But actually, despite everything that's gone on, the picture for investing over the past 5 years has actually still been really, really, really positive.
Marcus, one of the questions I get asked quite a lot as well is, should I invest now with markets being close to all-time highs? What do you say to clients when they're asking that question?
Yeah, and it's an interesting one because they are near all-time highs, but there's always a point every single year where markets are always at all-time highs. So, when I was doing this job, first started doing this job 20 odd years ago, I remember like the FTSE was it 6,000, 7,000 or something like that? And it fell to 3,500. And now we're at over 10,000. And if this was the all-time high for stock markets, then everything would consistently go down for the next 5, 10, 15, 20 years. But markets always rise, they always go higher. And if you look at the growth on, you'll probably have the figures better than me, Alex, but like the US markets over the past 10 years, like the growth on them is huge. FTSE trackers over 10 years is like double-digit return. So markets always get to all-time highs, but they always push on. So who knows where we'll be in 5 years' time? The FTSE could be at 12. It could only be at 11,000, but it could be at 14,000. And for those of you who don't know Alex had this hat in the office that was FTSE reaching 10,000. And at one point, we never thought it'd get there. And then it got there and it boomed on, way, way past that. So I think there's always reasons to invest. And I think, longer term, as that chart shows there now, you will always, not guaranteed, but you will generally always make money invested than you will sat in cash.
We've got another hat, make the FTSE great again as well. That's there was a bit of a joke when we started Luna that I was very positive on the UK market, and someone crafted a hat for me, which was very kind. But yeah, as Marcus said, it's got a bit of dust on. We weren't expecting to ever get it out, but it's come out now. Just want to touch on market corrections. This is, I was told the other week that it looks like a measles chart. So I'm now going to call it the measles chart. Goes back to 1986. You've got the red dots represent, well, what was the worst possible periods to invest during the year, so the intra-year decline. This is the MSCI World. So looking at a global equity stock market. The grey bars represent, well, what actually did the market do that year? There's a few important points I'd highlight here. So markets tend to be positive, well, 3/4 of the time, 29 years out of 40. So they're negative a quarter of the time. And you always have a fall in markets every year. There's always a concern that comes through. Last year was tariffs. This year's the war. It was the Ukraine war before that, etc. You can see there's always a red dot. And what we're going through at the moment is pretty normal. I mean, in fact, you could say it's not been that bad in terms of the market's fallen 8%, but the average median return of a negative is just over 10%. So the markets have kind of performed in line, and volatility within markets is very normal, as we said. And the important thing is to focus on the long term. Just going to summarize my slides, and we'll just see if there's any more points to mention. So the most important point is how long this conflict goes on for. The common sense approach is that this is done relatively quickly because Iran want to export commodities as one of their biggest drivers to their economy. The US look like they want to have a deal because it's going to impact global growth. The longer this goes on, the bigger the impact it's going to have on inflation, and we've already started to feel this. We were expecting interest rate cuts earlier on in the year. That looks off the table. The market is expecting interest rates to go up, as I said, once. I don't think that will happen because I think they're more worried about what's going on in the economy, but who knows? We'll wait and see. Bond markets and equity markets were very negatively impacted in March, but they have bounced back in April very strongly. Short-term noise is never nice. As I said, I'm probably going to take up the recommendation from one of my colleagues and turn off the TV and not log on to BBC News for a period of time because it clouds the opinion and it doesn't really help, and it makes you make bad decisions over the long term. We've been here before, as Marcus touched on. We've had 4 or 5 crises in the last 5-6 years. It happens, unfortunately. It'd be a lot easier for us if it didn't happen. But yeah, that's where we are. So I'm just going to stop sharing there. Marcus, is there any points you want to mention that we haven't touched on as we've been going through that today?
No, I think for those people out there who've got advisors, and everyone's at a different stage in life. It's often those who are retired who are focusing. They don't have another source of income apart from the assets that they've got, so they tend to be the most nervous clients. Obviously, lower risk clients, but they tend to be the most nervous. I think for anyone who's a bit younger, even for people who've got funds available, we can never time it exactly right. It can't be done perfectly. People might invest now and it might go down. But as I said before, for some clients, and I know that you do this, Alex, when you manage portfolios, but, rather than putting all the money in on day one, it's just drip feeding that in over a period of time. Those clients taking income, as I say, over 12 months, portfolios have still done really well, maybe taking some profit off the table, putting it in cash or doing something with it that's a bit more low risk. But it's an individual thing for most clients. So, speak to your advisor. If anyone's got any questions, speak to us. But I think despite what's happened, hopefully, we'll see an end to the conflict relatively soon. And if that does happen, then we'll probably see another big bounce in markets again.
Yeah, and I think, as you touched on then, it's already sort of happened. I mean, this is what the amazing thing about markets is they look through events. And one of my favorite stats is that during the pandemic, the low on the stock market was the day that Boris Johnson put the country into a national lockdown. Now, you really wouldn't expect stock markets to bottom when that's the case. You'd expect people to worry more, but it just highlights that a lot of the markets look ahead and they were pricing all that bad news. And as soon as they announced we're in a national lockdown, it was looking through and saying, well, when are we going to be coming out? And we didn't know when it was going to be. We didn't know when a vaccine was going to be created. And that's sort of where we are now. We don't know what the end game is going to be here, but it looks like the ceasefire talks have started. Hopefully, eventually they will be concluded. I don't know when. No one does. And that means that Straits of Hormuz hopefully reopens. Commodities start moving through, inflation starts to fall, etc. But as I said, if that isn't the case, and the longer this goes on, then countries and companies will start to adapt to be more resilient. Marcus, which may be relevant as well, to mention that we've just gone into a new tax year. Is there any kind of key things that you'd mention about, to make sure are being done as we've entered the new tax year?
Yeah, I mean, it's just the basics, isn't it, that we look at? I mean, capital gains tax planning, sort of using your allowances. We've got your pensions allowances up to 60,000. Obviously, pension rules are changing next year, so there's a bit of consideration on that one as well. Using your ISO allowances, getting things into tax-free environments as well. Maybe transferring assets between spouses as well to use up allowances. So there's, it's a new tax year, new allowances. So speak to your advisors about that sort of planning. As we said before, it's not a bad time to get in. You can still put money into your pensions and your ISAs. It doesn't mean that you necessarily have to invest it straight away. It can be held in lower risk funds or it can be held in cash. But save the rush, save a massive job for people like me in March when everyone comes last minute. Try and do it sooner rather than later.
No, I'd agree with that as well. I mean, for us, from an investment perspective, it's better to have money in ISAs and in the stocks and shares ISA and growing as much as possible early on in the year, and that's what we're doing already. We're moving money from general investment accounts and when they're not as tax efficient across and subbing people's ISAs, and we do that very early on in the tax year to make sure that we're making the most of the gains and it's in a tax sheltered environment.
Thank you.
Marie, I think we've come to the end of our section. I'm not conscious. Looks like there's a few questions that have popped through. If we want to work through them.
Yeah, great. Thank you. That was super interesting and absolutely timely. Yes, as you say, we have got some questions coming. So I'm just going to read those as they've come in. So first question. So what's the best things to do when you have global conflicts and uncertainty?
Do you want to take this, Marcus? Do you want me to take it?
Go on. It's probably better from you, that one, Alex.
Yeah, I'll certainly be going through in the slides. I think it's important not to panic is rule number one. Remember what you're investing for. So if it's your pension and you're investing for 10, 20 years, then what's going on in the next 5 minutes really isn't going to have an impact. What you want to do is stay invested and ride through this period of volatility. If you need to, speak to someone. As I said, this is when Marcus and myself are our busiest when we get times like this, because people do have a nervousness about investing because they can see their pension going down. It's completely normal. But what we're looking to do is, let's think about, let's plan for this. Let's take all the factors into consideration. So I suppose that's the first thing. And then maybe, as I said, turn off the TV is probably option number 2 as well.
Very good. Thank you. Okay, next question. So will the Bank of England be forced to increase interest rates like they did in 2022?
I don't think so. That chart highlighted, we were expecting 2 interest rate cuts this year. It now looks like it's expected that we're going to get 1 hike. But in 2022, interest rates were nearly 0, and inflation was running at 10, 11%. And before the conflict started, inflation was already running at 5. So where we are today, the starting point is different. But the longer this goes on, then the risk is that interest rates do have to go up because that inflation factor will be bigger. And the Bank of England have a target of keeping inflation at 2%, over 3% today. So we're already outside that target now. And the longer this goes on, the greater the risk that just carries on increasing. And then, as I mentioned, you've got those second order of impacts in terms of wages and potentially food prices to come as well.
Great, thank you. One final question then. So do you agree with the view that people will begin to move away from US equities due to Trump's actions this year?
Oh, that is a brilliant question. I think it's already happened, and I don't think it's US equities. I think it's US assets. So last year, when the tariffs were announced, Donald Trump basically upset the world. There's no other way of saying it. He slapped tariffs on every single country, even ones that didn't have people on that had penguins. And that has seen the dollar weaker over the last year or two because people aren't convinced about holding US assets when there's that risk and that volatility there. One of the biggest beneficiaries over the last year or two has been gold. So when Russia invaded the Ukraine, all the US and Europe closed all their accounts from Russian assets, so they froze them, so they can't access them. So other global central banks now are worried that if they did something similar, and I'm not saying it's going to happen, that the US and Europe will close all their accounts and freeze their assets, which means you've seen them selling down their US treasuries and buying gold instead. I think it's something I mentioned last time. Gold's been a bit more volatile over the last few months with everything that's happened, but it has had a phenomenal run. So you're already starting to see that US equities. I mean, the risk with US equities is they're more expensive than everywhere else, but they are more profitable businesses. And the next wave that we're seeing at the moment is what's going to happen with AI and who are going to be the beneficiaries of that. And that's principally companies that are based in the US. So we'll wait and see. I don't know. I think investors will not run away from US equities as long as they're delivering good earnings, generating good cash, and delivering good returns as they have been. But as soon as that changes, that's when you'll see people leave US equities, I think. But as I said, it's more the dollar that is at risk, in my view, and US debt.
Great, thank you. There's another question come in that's really interesting, so I'm just going to put this one to you, and that'll be our last question before we move on to the next session. So I'll read it as it's coming. So, are you seeing clients considering moving their businesses or investments from the UK to other jurisdictions, or are more people looking to invest in the UK?
Marcus, you want to touch on that, and then I've got a few thoughts on that.
Yeah, it's interesting because with the changes to things like business property relief that came into effect only a few weeks ago, we've got clients who maybe had very little or a small inheritance tax liability suddenly have multi-million pound IHT liabilities. And from a planning point of view, we've seen an increase in people looking to move. Not necessarily. I mean, obviously, places like Dubai were a place to go. It's probably not the best place to be at the moment. But we've had clients move to the Isle of Man, to the Channel Islands, different areas where there is obviously far lower taxes. But it tends to be post business sale. So once they've sold a business, they then move. Obviously, relocating a business, this is more an accountancy question. I'm sure there's people on the call that are better qualified than me to answer it. But it's obviously quite hard to just simply relocate a business to a completely different jurisdiction. But what we're seeing generally from a financial planning point of view is people looking at moving to a different country, whereby some of them have rules like the Isle of Man. After 10 years, you've got no inheritance tax liability. So they're actually selling businesses, moving abroad, taking that wealth overseas. So it is quite an interesting question. And in terms of investing in the UK, I think, like Alex said, I think we've had a period. Alex might be better to comment on this than me, but UK equities have actually had a fairly good run recently compared to the US, and we've seen clients. I think partly like the question before about Trump, in that clients are less keen to invest in the US. So we've seen a bit more investing in the UK smaller companies. But I don't know what your view on that is, Alex, in terms of the investing element.
Yeah, I think that you are seeing more investment and interest in UK companies. The London Stock Exchange are looking to make some rules to make it more attractive to invest in the UK. So certainly a positive. Just to bring back to, I'm conscious of time, Marie, but the only thing I'd add to what Marcus mentioned is 5 years or so ago, we didn't have any clients come to us talking about moving abroad. I think the last year or so that those numbers have increased significantly, and that's because the stealth taxes and freezing of national income tax bans means that as a proportion of our salary, we're paying more in tax than we ever have done, and people are looking at that versus other countries and making decisions. So, and I think if the longer this continues and the more of it happens, there's potential for an exit tax or wealth tax as people leave. The UK is one of the only countries in the G20 that doesn't have one. To see if that comes in the coming years. And if it did, it would be done very quickly because they won't want to give anyone wind of it.
Brilliant. Thank you very much for an extremely comprehensive session today. Alex, thank you for your video holding out as well.
Thank you for having me. Thanks, Marie.
Thank you. Right, so we'll move on to our second part of the session. So I'm very pleased to be able to introduce to you a colleague from Quantum, Hannah Griffin. Hannah is a forensic accounting expert and a managing director. She leads Quantum's disputes, investigations, evaluations practice in the Midlands and has 20 years of experience in business and share valuations. Hannah, this is your debut on the K3 Hub. Welcome. Over to you.
Thanks very much, Marie. Good to see you. Well, not to see you because I can't see anyone other than myself, unfortunately, but brilliant to see names on the attendee list that I recognise. So thanks very much. Right, let me see if I can get the tech working. I'm going to share a screen, hopefully now. Here we go. Okay, right. So yes, brilliant to see everyone. Thank you for joining us today. So I am a forensic accountant, which is another way of saying that I'm quite a nosy accountant. I specialise in expert witness services and in a particular interest in contentious business valuations. And so whilst the majority of the work that I do is in a contentious setting, I'm going to talk you through what hopefully will be useful to you all, which is the valuation of private companies and share interests in them. So my practice area covers a variety of dispute situations, but I do work in the non-contentious world. But what I don't do, and I will defer to my colleagues at K3 Tax, is get involved in fiscal valuations. So the world of company and share valuations is complex. A couple of quotations to get us going. In 2005, in what I think was a family court hearing, Justice Coleridge described valuations of companies as an art and not a science. A few years later, Justice Charles spoke about how highly competent valuers using the same method of valuation can reach wildly different valuations, and that variances is fairly regularly encountered, and it's the effect of the elements of opinion applied by valuers. So this basically tells us that there's rarely one right answer, and in reality, the value of the business will sit within a range. But that doesn't mean that a valuation can't be wrong. So we've seen examples of valuations where the valuer has valued the wrong thing. They may have valued the right thing, but at the wrong valuation date. And in some cases, actually, where the valuer has just used a completely inappropriate method of valuation. So it's really important that you do use an experienced valuer. Right. So I've got about 35 minutes. What I'm going to run through with you is to give you a little bit of an overview of some different bases of valuation, but I'll focus on market value because that's certainly the most common method of valuation that we're instructed to undertake. I'll talk you through the information that a valuer will need if they're going to do a valuation. Then I'll move on to some of the different methodologies. In particular, I'll talk you through in a bit more detail asset valuations and the earnings-based valuation approach. And these are basically, certainly on the earnings valuations, this will give you a value of the business rather than the share interests. So what I will then do is talk you through how to take the valuation from the business value down to what the shareholders' interests are in it. And finally, some points to think about if the share interest is a minority interest. Okay, so the IVSC, the International Valuation Standards Council, was founded back in the 80s, and the purpose of it was to develop a set of common international real estate valuation standards. It was originally intended to relate to the valuation of property, but it's now considered reasonable to apply it to the valuation of a variety of types of assets. Market value. So this is a base defined by the IVSC, and it is commonly used as a basis in disputes. And there's a case against the Inland Revenue in respect of Lionel, where the judge described market value as the hypothetical sale between a hypothetical willing vendor and a hypothetical willing purchaser. And it assumes that no one is excluded from buying. So it's a situation where obviously you're not marketing the business, you can't test it in the market, but you're assuming a number of hypothetical elements. I'll come back to that in a little more detail shortly. Equitable value, another basis in per the IVSC, is where you're valuing based on knowing the identity of the specific parties involved, rather than it being a market valuation where everyone can bid. Investment value and synergistic value, they look at the value to a particular owner. So investment value looks specifically at the investor's identified investment objectives. And synergistic value is where you're looking at the benefit of bringing two or more assets together, where collectively the combined value will be greater than the individual values. Okay, and there are a couple of other approaches which I will just skim over, but liquidation value, basically looking at the costs if the business is wound up. Sorry, looking at the value of a business if it's wound up, thinking about extra costs such as redundancy costs and early termination penalties if you're having to wind up a business. Okay, back to market value, my favourite. Right. So as I said, you're in this situation, and the valuations that I perform, I don't have the ability to take a business to market. I don't have the ability to test it in the market, and so I'm having to assume a hypothetical sale. So the hypothetical parties here are willing, meaning that I have to assume they're not compelled to buy or over-eager or forced to sell. In undertaking these valuations, I need to assume that everyone can bid, including the company directors, and that the parties have undertaken all the necessary preparations so that they're acting with knowledge, prudently and without compulsion, and that each party will have a reasonable knowledge of the business to act with self-interest and to seek the best price for their respective positions. What's really important is that a valuation is done at a specific valuation date, and getting the valuation date correct, or certainly considering what would be the most appropriate valuation date, can be something that we help clients with. Because a valuation done last year may no longer be appropriate today. It may not be appropriate if it had been valued 3 months ago. Factors impacting, as you've seen on the previous slides, the volatility in the markets can have an impact. But excuse me. And the other final important thing that I have to consider, and which is similar to if the business were being sold, is that the information can only be I can only rely on information that would have been known or foreseeable at the valuation date, so I can't apply any hindsight. So what do I need to undertake a valuation? I need information that helps me understand what the company does, how it generates money, who its key customers and suppliers are, and importantly, what its future prospects or plans might be, and who the business, who are the key individuals within the business. In some instances, it might be necessary for me to visit the business. I mean, there's a lot to be said, and there's a lot of value to be had from seeing a business in operation, talking to the key personnel, seeing the manufacturing process. You can get a very different feel to a business from seeing it with your own eyes to sometimes how information is presented in a written document. The information will fall into two categories, say public sources and private sources. So articles of association will be available through Companies House. So they will set out information around how shares are to be how the shares are to be valued. Agreements, shareholders agreements, partnership agreements, obviously private information, which depending on who's instructed you to perform the valuation may or may not have access to. The Companies House, you'll be able to get information, or the valuer will be able to get information at a high level about a business. What a valuer really needs is the detailed profit and loss account, though. So the limitations that with information at Companies House are that in some cases, particularly in small private businesses, you won't actually even have a profit and loss account. So getting hold of the detailed financial statements is really important. Management accounts and budgets and forecasts. So the majority of the valuations that I get involved with are owner-managed businesses, and I guess the thing that to flag here is that whilst management accounts and budgets and forecasts are really useful for a valuer, they sometimes are prepared on a different basis to the statutory accounts. They may not be updated for things like, certainly management accounts may not be updated for accurate stock valuations, and budgets and forecasts. Quite often small companies don't prepare these, and so understanding, if you are given this information, quite why it was prepared in the first place, you know, in a situation, a situation involving a dispute, sometimes the forecast can have been prepared specifically for that purpose and may not, or may, I say, contain an element of bias. So moving on. There are several ways that you can value businesses. Some may not be appropriate in every situation, though. And the valuer, this is where the valuer's expertise and experience is important. There may, in some cases, be evidence of recent transactions in the company's shares, and this will be registered at Companies House. It may be a little bit out of date, though, or certainly not up to date. And it's also worth flagging that whilst there may have been transactions in a private company's shares, they may not be at market value. So if you're instructed to undertake a market valuation, you need to be mindful that there may be special circumstances involving those share transactions. The asset-based approach, I'll come on to that in a bit more detail. It's not the most common methodology that we use. The most common valuation approach would be the earnings valuation, or the market approach using an earnings valuation. Discounted cash flows, they're certainly relevant when you've got a startup business, so you don't have any historic trading history to rely on. And they can be used where you've got a business that's got a finite lifespan, for example, a landfill. But they do, to be able to do a discounted cash flow, you do need robust profit and loss and cash flow forecasts, which as I've mentioned before, not all businesses, particularly small businesses, will prepare. And then finally, if you're valuing a dividend, if you're valuing a minority interest in a company, it may be possible to value that using the dividend yield approach. This requires the company to have a dividend policy, though, and a history of paying dividends, and that the minority shareholder that you're valuing the shares of isn't able to influence the dividend that's being paid. So they're not typically relevant for owner-managed or family-managed businesses. What a valuer would like to do where possible is to test a valuation by applying multiple methods. And this can be challenging because you generally won't get as much information as you would like. So going back to the experience of the valuer is really important. Okay, so when are asset valuations appropriate? So an asset valuation will value the business based on the value of the net assets of that company or that business. It's rarely used except for valuing businesses which have whose main purpose is to generate capital growth rather than trading profits. So it's used a lot for valuing property and investment companies. It can be used for valuing businesses that have historically been a bit variable in their profitability or may not have made profits, or where the business going forward is going to change significantly and there's little information about the future operations of the business, or certainly not that's been made available to the valuer. There are valuations of farming businesses often use the asset approach. And it's not just a case of looking at the bottom line of the balance sheet. It's usually necessary to make several adjustments. So you need to be thinking about whether the balance sheet includes any assets which are included at cost, which have a much higher market value. So if the business has freehold, leasehold properties that have been owned for several years and haven't been revalued, then you may need to get a surveyor to advise on the value of those assets at the valuation date. The balance sheet may also contain things that have no recoverable value, for example, goodwill. And the other really important thing to consider is whether there are any off-balance sheet assets and liabilities. So if going back to the position around the property, if you've got some property valuations, properties that have been uplifted, revalued, is there the inherent tax reflected in the balance sheet if that property is sold? And the valuer will need to determine the likelihood of the property being sold and whether a full or a partial reflection of the tax liability should be reflected in the valuation. And finally, the other thing to mention is that when often the valuation date, the financial information will precede the valuation date, depending how much earlier it is before. You may need to consider whether things will have changed since then, and make an adjustment for improvements or decreases in the value of the balance sheet as a result. Okay. Just bear with me, apologies. The market approach. Okay. So this approach assumes the company will continue as a going concern, and it involves evaluation of a business is typically on the market approach. You're looking at the future potential of that business, and so the valuer is really interested in the future maintainable earnings of that business, and those earnings are then capitalized using an appropriate rate, the multiple, and that rate is designed to reflect the expected risk of achieving those earnings. These valuations attribute what's called or equate to the enterprise value of the business. It's the total value of the underlying business as opposed to the value of the shareholders' equity in the company. Depending on the approach taken, the future maintainable earnings can be assessed by reference to EBIT, so earnings before interest and tax. It might be appropriate to use earnings before interest, tax, depreciation, and amortization, which is known as EBITDA, or using pre-tax or post-tax profits. And over the years, many industries have developed their own sector-specific rules of thumb for market approach valuations. Professional service firms, like the one that I work for, have historically transacted on a multiple of recurring fee income. But more and more often now, we're seeing that actually a lot more valuations are being undertaken on a future maintainable earnings, an EBITDA basis. So how do we work out future maintainable earnings? As I said, we're looking at the future expectations. So it's very much a forward-looking view that's needed, that the valuer needs to adopt. Often the EBITDA approach is preferred as the basis for the maintainable earnings. So EBITDA is preferred, I would say, because it removes the impact of some company-specific policies, such as how they depreciate their fixed assets and how a particular business owner would choose to fund their business, which can vary from owner to owner. So EBITDA strips out the impacts of depreciation. It strips out the interest charges as well as some other costs. And so whilst we're looking at trying to identify the future profitability, the historic performance is generally important, but it doesn't mean that it's going to equate to the future. A valuer will have to consider the various sources of information that they can access and then determine which is the most relevant. In principle, a valuer would have no problem in using management accounts as part of the calculation of future maintainable earnings, but they need to be satisfied that they are robust, they're reliable, and that the estimates contained within them are reasonable and realistic. As I said earlier, in some cases, management accounts are less accurate than the year-end accounts because of the provisions and the reviews that are undertaken, how regular they're undertaken, bad debt reviews, stock adjustments, etc., etc. And if a valuer is going to use management accounts, they may consider that they will apply less weighting to them, depending on what they identify in their review. Statutory accounts and the forecasts, again, the forecasts, they need to be tested. The valuer will need to check that they're prepared in a like-for-like basis with the historical accounts. And again, just be making sure that you consider what the purpose of those forecasts, why they've been prepared. So if the valuer in my example, I'm assuming that the valuation is being done on an EBITDA basis, and the EBITDA, the valuer will be able to derive the EBITDA from the company accounts. And they'll need to then consider what adjustments are needed to reflect what the market would consider are reasonable costs within this business. So, some obvious examples of adjustments that a valuer will make. Anything that's one-off or exceptional, a buyer of that business is not going to want to pay for a business based on unusual events. So a valuer will strip out anything obvious within the accounts which are not recurring, and then the valuer will need to use their judgment and their professional experience to look and to identify other less obvious adjustments that are needed. These often in owner-managed businesses, there are adjustments to reflect directors' remuneration. An owner or a manager may receive more in the way of salary or benefits than they would if they were managing that business on behalf of someone else. And the valuer in that case would need to strip out the proprietorial benefits. On the other hand, there can be the case where directors are remunerated by dividends, or sometimes they've got a loan account they can draw against tax-free. And in those situations, there may be no charge for the director's remuneration or time spent working on behalf of the company. So in all cases, the valuer will need to consider how much the company is paying the person in total, irrespective of how it's described in the accounts, and what the going rate for that job and the role the going rate for the job is, and whether actually the role is needed by that business. Often the case again in owner-managed businesses, we see situations where the property is owned by a connected company or a connected party, shall I say, and so rent can often require adjustment to bring it in line with the market rent. It's really important to understand who the landlord is, and as in any kind of property-related expertise, we would turn to a surveyor to advise us on the appropriate value or rental assessment. So the valuer has taken quite a lot of time understanding the business. They've come to an adjusted assessment of the EBITDA to reflect third-party ownership and what the market would consider to be reasonable costs. And they then need to determine over how many years they're going to rely on, whether they will apply more weighting, for example, to more recent years than historic years. Typically, a valuer will go back maximum of 3 years, looking at historic performance. And it's really important for the valuer, as we've been talking about earlier on. As I've mentioned, we are trying. The aim of this is to understand what the future potential is. So, how much reliance you will place on the historic results versus the future prospects shown by cash flow may impact the averaging approach the valuer will adopt. And they're all case and fact specific, so there isn't a hard and fast rule, I'm afraid. Once you've got to an idea of the maintainable earnings, you then need to consider what's an appropriate multiple. And this is one of the most subjective parts of the valuation. It's really important to apply a like-for-like multiple. So I have seen cases where a valuer has calculated their maintainable earnings using profit after tax, but has then applied an EBITDA multiple to that, which is completely inappropriate. So if you're using EBITDA, you must make sure you're using an enterprise EBITDA multiple. If you're looking at profit after tax, it's a PE multiple. And there are various different sources, or there are various sources of data for your multiples. Many valuers will subscribe to a platform, such as the S&P Capital IQ. This collates transaction information. It allows the valuer to search for transactions in a specific sector across a specific time frame, and that time frame is dictated by what the valuation date is that you're being asked to do your valuation at. But the information that you get out is, it takes, it needs to be critically reviewed. You can't just rely on it because the transaction data may not be particularly comparable to your company that you're looking at. It may be significantly different in terms of its overall size. Smaller companies tend to attract smaller multiples. The profitability and the historic growth may be very different. So it's really important to look into those transactions in detail and to take what is, whilst it may be a business in a similar sector, it may be very different to the business that you're actually valuing for a number of reasons. There are publications that a valuer can rely on. Examples of these are the BVB reports, UK 200, BDO's PCPI, and they all provide information of transactions. Typically, they're about 15 months out of date. So if I was doing a valuation now, I wouldn't have information, possibly have some information in respect of 2025, but possibly not in some of these publications. And some, UK 200 and certainly the BDO PCPI, they don't report transaction information by sector there. So there's no sector identification. It is a collective multiple that you will obtain. And so again, a sort of a fair amount of caution in how you use this information. It's certainly not a pick it up and put that multiple in your calculations. Publicly traded share indexes can be useful, such as the FTSE 100. The key difference, though, in what I'm typically valuing, which are family or smaller owner managed private companies, is that the shares aren't readily marketable compared to shares in a quoted company. And of course, the shares in a quoted company will give you an idea of a minority shareholding, which may not always be the case for what you're looking at. And then finally, I've just flagged on here that in-house also is helpful. So I work obviously within the K3 advisory group, where we have KBS Corporate and a number of other corporate businesses, which are transacting in companies all the time. So being able to speak with my colleagues across the various businesses is really helpful for getting information on transaction multiples. The key is making sure that what you apply to your valuation is relevant and comparable to the business that you're valuing. Okay. So once I've assessed maintainable earnings and I've determined the appropriate multiple, it's going to give me a valuation of the underlying business. And what I'm often asked to do is to value what the valuation of the shareholders' equity in the company is. So I have to make a number of adjustments to this. Adjustments are needed to reflect that if there's any debt in the business. So things such as bank borrowings, directors' loan accounts, corporation tax will be deducted from my valuation, from my enterprise valuation. And then the value will need to think about whether there are surplus and non-trading assets within this business that won't have been captured in the valuation of the trading operations. So things such as investment properties, investments in other companies, and if there's some excess cash in the business which is over and above the necessary, the day-to-day working capital needs. As a nosy accountant, I particularly like looking for personal assets that may be hidden within a business, but which actually aren't necessary for delivering the business's objectives. So after we make adjustments for these, this takes us to the value of the equity in the business. the final point. Sorry, I do feel as though it's gone very quickly and it's fairly complicated. So anyone wants to pick up with me offline, please do so either via email or phone. Not a problem. Very happy to talk valuations all day. But when I'm looking at valuing a shareholding, then, and particularly a small shareholding, the shareholdings may not attract a prorated share based on, it's a 10% shareholding in a company with an equity value of 10 million may not be valued at 1 million. It may, in many cases, be lower. So consideration needs to be given for what the company's articles specifically say regarding the rights and entitlements attaching to the various class of shares. Any provisions in a shareholders agreement can determine how the shares are to be valued in a transfer. Also thinking about whether what the company's dividend history is. So if you've got a small interest in a private company, it's probably more it will be more valuable if the company's historically paid dividends to you, and the rate of and the higher the rate of dividend, the more value you're likely to attribute to that in shareholding, assuming, of course, that the track record is likely to be maintained. If the business is likely to be sold or floated in the foreseeable future, then in that situation, a minority interest would receive the prorated value of their shares. So you need to consider if that's possible. And if it is, in that case, it would be unfair to apply a minority discount to a small interest. But the size of the minority shareholding and the relative holding of the other shareholders is important to consider. So if a shareholder could acquire the minority interest and take their voting rights to over 25%, it would give them the ability to block a special resolution. If the other shareholders could gain over 50%, it gives them day-to-day control. And if they could get over 75% of the voting rights, then they have the ability to force special resolutions through. So, minority share interests may in some cases attract a premium. And in this example on here, a 2% interest with two other 49% shareholders could mean that 2% interest attracts a significant premium. And the final point to make is that quasi-partnerships can have a massive impact on the value of a minority interest. So it's very much fact dependent on whether a business is a quasi-partnership, and it's often for the judge to make that determination. But if shareholdings in quasi-partnerships do not attract a minority discount. So I have covered all the slides. I hope that's given everyone a bit of an overview of how we go about valuations of companies and shares. And I will hand back to Marie.
Thank you very much, Hannah. That was super interesting, and judging by the number of questions that we've had in, also for our delegates today. So I am before I get into the questions, I have 3 very short webinar sessions to plug for our delegates just before I jump into your questions. So 15th of May, we've got a family tax planning and IHT CPD session. Another CPD session on the 19th of June, which is corporate tax. And again, on the 3rd of July, how AI supercharges your finance team. You'll get emails with registration details. You can also go onto the K3 Hub website, register there, and we'll be promoting on LinkedIn. Right, into your questions, Hannah. And I'll put you through your paces. Right, so we'll start with a quick fire round. So where does one find the sector rules of thumb for earnings?
So you'll be able to find that information. You'll be able to certainly find the appropriately reported multiples for things like professional service firms through subscriptions like the S&P Capital IQ. It is a little bit of needing to talk to someone in the sector to understand, or certainly somebody with valuations experience to understand which sectors have sector-specific rules of thumb, and it can come down to having examples of, looking for evidence of transactions of businesses in those sectors and what the reported metrics are.
Lovely, thank you. Right, your next question. When does one choose MPV for valuations?
Sorry, maybe I've got somebody drilling in the background in our.
Oh, okay.
Could I get you to speak up a bit?
Yeah, sure. When does one choose NPV for valuations?
Okay, so net present value. So I think that's a question around discounted cash flow valuations. So discounted cash flows are taking the future cash flows of a business and discounting them to a present value. They're most appropriate when you value businesses which are maybe a startup, so you don't have any historic results to rely on, or where you've got a business that's perhaps changed very significantly, and so the historic performance is less relevant. Well, certainly it is irrelevant actually to what you're going to be doing going forwards. So you would be looking at the future earnings and discounting them to a present day valuation using a discount rate. Hopefully that's answered that question, but if not, then I'm very happy to pick it up on the phone.
Yeah, well, we'll gather all of the questions up for you and pass them over after the session, because we are definitely not going to be able to make it through these. So I'm going to ask you one final question here, and I'm just going to, let me see. Right, so this one looks quite popular. So for business owners looking to get ready for a company share sale, what advice would you give them in order to realize the best possible valuation?
Oh, okay. Well, I would say instruct good advisors. For if you're actually selling the whole business, and you're going to sell the business, then come and talk to our colleagues in the corporate finance business at Quantum or at K3. If you're a shareholder in a business and you want to exit, then thinking about the timing and the value of the business is all about the future. So thinking about the most how you present that information about the future performance of the business is important.
Great, and I think we've got time for just one more. So, are you able to give any indication of what average multiples and average minority discounts currently are?
Oh, I think it's really difficult because there isn't a specific discount to apply to a specific shareholding in a company. It depends, it can come down to one, how the business has been valued, because if it's a business that's got lots of tangible assets that can be sold off, compared to a business that's perhaps more generated, it's the majority of its value has come from goodwill. That's harder to kind of transfer into cash. So there isn't a hard and fast rule. It comes down to experience. It comes down to knowing who the other shareholders are, what your minority shareholding, what that particular shareholding whether it's attractive to others. And yes, there's not. I'm afraid there's not a. There are some guides, but I wouldn't want to suggest that somebody followed them and didn't get the appropriate advice.
That's great. Thank you very much. Well, I'm afraid we are out of time for today. So thank you very much to you, Hannah, Marcus, and Alex for joining us today. Really insightful sessions. and look forward to you all coming back and joining us again soon. We do have a lot of questions left over for Hannah, which we haven't had time to get through. We are going to package all of those up and send them over. Hannah, hopefully you could be able to go back to the people that have asked those questions quite quickly. Otherwise, all that's left to say then is thank you very much to all of our delegates for joining us. We've had an awful lot of people joining us today. And have a great weekend when it arrives. Thanks, everyone.
Thank you.
Thanks a lot.
Thanks, bye.
Bye.